Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. Today we're looking at the risk facing Asian markets in the final stretch of 2024. In a short while, we'll hear from Naomi Fink, Chief Global Strategist at Nikko Asset Management. But first, the Bank of Korea cut its key interest rate today by a quarter point to 3%. This move was very much unexpected, and it follows a policy pivot last month. For a closer look at the BOK's action, we're joined by Bloomberg's Mark Cranfield. He is Bloomberg MLIV strategist, and you can read Mark's writing on the terminal at MLIV Go. Mark, thanks for joining us. I know you're in Singapore today. I'm sure you've had a very busy day. Why was this so surprising that the BOK decided to cut rates?
They've been hinting that they were comfortable with taking a very gradual approach, and I think some investors were thinking that they would take more time to see how things played out in terms of the next Donald Trump administration. And today, only 4 people were expecting this out of 22 people surveyed for the meeting, so you can tell it was definitely a surprise to the market. It looks very much as though, although the Bank of Korea cited the fact that they do see inflation coming down next year, they see growth slowing a bit as well. I think there's a big nod to the trade risks which could encompass the world next year. So Korea is very dependent on its export sector, and from some of the things they would have heard from Mr. Trump in the last few days, they're probably pretty nervous that there could be a slowing of global trade next year, which would definitely affect them as it would most of Asia. So this is beginning to look like a preemptive move. It looks like they're getting out ahead of the rest of the pack, trying to do something that could help the Korean economy before they face too much competition from other people.
So the idea here is to try to weaken the currency just a bit, to be a little bit more competitive with your exports, right?
There's nothing unusual in Asian central banks doing things to help their currency in terms of the trade situation. So allowing currencies to be a bit softer than usual, to maximizing the dollar strength, which we're generally seeing the dollar in a pretty good condition since the recent elections. It was strong before the elections, but it's got even stronger since the presidential elections. But it's typical for Asian central banks to allow the currency to take the strain, but doing it at the same time as lowering interest rates obviously gives it even more impetus as well. So you've got a competitive situation between the Korean won, the Chinese yuan, the Japanese yen. They're all competing in similar areas. So every country obviously wants to do the best they can do to help its own trade situation.
When I think of Trump tariffs and markets in Asia, I think of obviously China. Is there a way that we're seeing Chinese firms beginning to move some of their production line through South Korea as a way of avoiding tariffs in the future?
There's been plenty of writing on the Bloomberg terminal itself saying that really since the first presidential term for Donald Trump, Chinese companies in general have been very active around the world, trying to diversify their strategies away from directly going to the United States. So they've been making big investments and growing factories in various countries in order to try and circumvent any roadblocks that were put in with direct China to US trade flows. And that has resulted in the fact that now, if you look at the official import numbers between the United States and China, shows that there's been quite a substantial drop in the direct imports the United States makes from China. But behind the scenes, it appears as though the trade numbers between the two are still pretty big. And that's because China's done a better job of getting around it than some other countries. We would expect something like that to continue. China is very aware that they are at risk. There could be more tariffs put on them. And so they certainly are going to be working hard to try and make sure that they can still sell their products, but maybe through a different route.
So today in the U.S., we got the Fed's preferred measure of underlying inflation. The PCE accelerated a bit in the month of October, and I'm referring to kind of the core rate. This seems to validate a much more cautious approach when it comes to cutting interest rates. And then when you hear some analysis coming from the Mexican government that these proposed tariffs that the president-elect is considering, not only for Mexico, but for Canada as well, would contribute to higher inflation in the U.S. If we're talking about a world where the Fed is going to be a little bit more cautious, does it necessarily mean that the dollar is going to remain stronger for the foreseeable future?
From the Fed's point of view, from that angle alone, you would expect the US dollar to gain a reasonable amount of support if the Federal Reserve is slowing the pace of interest rate cuts. That would be a typical response that markets would expect. However, the wild card, as usual, here is Donald Trump, who could easily say in a few months' time, I think the US dollar is too strong, and then the whole situation could change dramatically. He has been known in the past to say that he doesn't really, or he favors a slightly weaker US currency to help with the trade situation. So no matter what the central bank does in terms of slowing the pace of rate cuts, if you get a big intervention from the president, the whole situation could change very quickly.
So markets are increasingly pricing in maybe a potential rate cut from the Fed in December, a big question mark in terms of what happens in 2025. Flip side of that coin is Japan. And from what I understand, wage negotiations are moving toward a positive conclusion. Does that necessarily mean that we could see either in December or January a rate hike from the Bank of Japan?
Oh, traders are certainly warming up to the idea. If you look at the pricing in the futures markets and derivative markets, we're now at something like a 60% probability the Bank of Japan will actually go in December. They'll actually raise by 25 basis points already. So traders are getting certainly more convinced. I think that's part of the reason for the recent yen strength, the fact that the yen has rebounded a bit in the past few days.
Yeah.
The wage hikes, the proposals for next year look pretty serious. They look as though they're going again for big numbers, even though they had very substantial rises this year. And the Japanese Prime Minister has been consistently saying that he supports that. He wants to see companies allowing higher wages to their workers. He's even talking about a minimum wage for the first time in Japan as well. So everything is pointing to the fact that the inflationary aspects from wages we saw this year will not dampen at all when we go in. In fact, they might even get worse in 2025. That obviously helps the Bank of Japan's case for keeping interest rates high and for raising rates again next year.
Before I let you go, I have to ask you about China, because the other day we learned that industrial profits in the month of October fell 10% year over year. So we're well aware of this deflationary pressure that China's been feeling for some time. Is there anything that can be done to begin to resuscitate the economy where it can maybe begin to emerge from this deflationary period?
It's getting the consumers to do more is really the thing you keep on hearing from people that watch China very closely is that Chinese consumers have become very cautious. They need a lot more incentives to get out there and spend money. The Chinese government seems to be making the right sound bites in that direction, but there's probably much more to do. So they've got some big meetings coming up in the next few weeks, and people will be watching very closely to see what measures are they doing to help consumers be more active in 2025. That will make a huge difference to the Chinese economy.
Mark, it's always a pleasure. Thanks so much for joining us. Mark Cranfield there, Bloomberg MLIV strategist, joining us from the Lion City of Singapore here on the Daybreak Asia podcast. Welcome back to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. President-elect Trump's announcement of an additional 10% tariff on Chinese goods has sent ripples through the APAC region. For more, we heard from Naomi Fink. She is the chief global strategist at Nikko Asset Management. She spoke exclusively to Bloomberg Sherry An and Heidi Stroud-Watts.
This week, we've been dissecting what the tariff impact could be on Asian markets. What's top of mind for you?
Well, I think going into year end and next year, a new administration in the U.S., we're all to some extent playing the waiting game. We did have the initial reaction to the results of the election, but now that's old news. And now we're in the difficult situation of trying to separate the news from the noise. And while there is news, there's also, as tends to be the case when new administrations have not yet taken power, a lot of noise. So it's we don't necessarily want to make big reactions to policies that may not actually come to fruition. We've had some noise about tariffs. Will those actually happen, or are they just a negotiating tactic? We don't know that yet. So I think at the moment we still see some pretty robust fundamentals in the U.S. economy, for example. So I don't think there's any reason to think that's suddenly going to stop. But what I would advise is to take a healthy hedge against some of the tail risks that might be coming up next year.
Like spiking yields?
For example, we do have 120% U.S. debt to GDP. And even though if we have fiscal easing, that on its own might look really good for stocks, we also do have the fear that that eventually that might lead to some unwieldiness of the debt and foreign investors who are necessary to fund the U.S. current account deficit, saying that they're not receiving enough of a yield premium. So that is always a risk.
And, of course, a stronger U.S. dollar that we continue to see right now and the pressure on their counterparts across Asia. How big of a problem could this be for some central banks, like South Korea, for example? As I mentioned earlier, the BOK seems to be really focused on financial stability, despite the fact that the economy seems to be struggling.
Well, of course, the Bank of Korea's job is probably to take a look inwards at the domestic economy and respond to that. But I think it cannot ignore what's going on with currencies and the weakening won, for example. I think it, in some ways, it might allow the weakening won might allow the luxury to wait a little bit and see what actually comes to the fore in terms of news, because I think that's probably many of the economies in Asia right now, that we're actually waiting for the news to hit rather than reacting to the noise.
Yeah, you're waiting. It's a difficult game, right? Because you've seen a lot of corporates, for example, not wanting to wait. They think that they know what's going to happen. They're front-loading a lot of their moves ahead of going into next year, right? Is your gut feeling, based on sort of, previous expectations, is that President Trump the second time around will make good on all of his campaign rhetoric and that we should expect him to do what he's said that he's going to do so far?
So if we're thinking about all the campaign rhetoric, I would think that's unlikely. Some, that's more likely. And I think that is the crux of separating the news from the noise. Some of it's news, but a lot of it's probably noise. And we do have the potential for some of what looks like news to be a negotiating tactic to achieve another end that's not necessarily apparent. So I wouldn't necessarily go hook, line, and sinker into all of the campaign promises. I would take a look at the likelihood of these policies materializing. Right now it's very confusing, but it should become clearer as we go into 2025.
When you take a look at some of the economies that he's targeted so far, obviously China is one of them, and it's quite interesting looking at what his potential US trade representative talks about in terms of a real fundamental revocation of the existing relationship, right? Do you think some of these economies, are better placed than others to withstand that? There's a lot of decorrelated assets in China that might be okay.
Well, yes, let's look at China for a second. The one thing that China probably has in its favor is that it hasn't dispensed a lot of the fiscal easing that it can dispense with just yet, and perhaps that's purposeful. Maybe China is waiting for the first move to come from the new U.S. administration, and then to try and react to that. It's keeping its powder dry. Right now, there is a pretty good issuance environment for Chinese bonds, and with those Chinese bonds, it's probably possible to finance quite a lot of new fiscal stimulus. So I don't think we're done seeing fiscal stimulus in China just yet. I don't think we necessarily want to trade on it right now, but there is some potential for things not being as bearish as initially perceived in China going into 2025.
Naomi, what's happening with the Japanese yen right now? I mean, this week I was a little bit surprised to see the strength that seemed to get started around the time when we heard about the tariff threats from Trump. And before, especially the past year, I mean, the downside pressure on the yen has been so strong that anytime we had some geopolitical risk or what we were supposed to think we could see some haven flows into the Japanese yen, we haven't. So what's changed this week?
Well, I think during the last year, we didn't really see haven flows into almost anything, even when geopolitical risk rose. Yes, for example, we saw strong gold, but that seemed to be to really try and gain a diversification away from the main event, which is basically major concentration in U.S. stocks. It's concentrated in 7 names. And perhaps we, too, don't think that it's time to get bearish on U.S. stocks just yet, but you need a good diversification tool. And I think that the yen right now is one of those diversification tools. Yes, it's not a relatively favorable yield that's attached to the yen, but maybe you can sacrifice a little bit of that yield, especially on the bond side, in order to hedge against some of the downside risk. And when markets do actually get a little bit frightened and there are risk-off trades, then the yen usually does benefit. So I think the yen is an important part of your global portfolio.
Naomi Fink, Chief Global Strategist at Nikko Asset Management.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.